Hi all, and welcome to the market outlook video for the month. Hope you had a good time celebrating Diwali with your friends and family. So the month of October was not been good for the equities. We have seen most of the indices correcting in India and globally too. Nifty corrected around 6.12%, mid cap was down by around 6.4%, small cap was also down by around 3.58%, and the micro cap was also down by around 3.33%. Whereas the Nasdaq was up by around 0.59%, and China market also corrected by around 4.3%. Gold at the other end was up by around 5.2%. So despite the correction which we saw in October, the one-year returns of our markets still look quite good. And if you look at Nifty is up around 28% in last 1 year, with mid cap with 44% and small cap with around 48% of returns they've given in last 1 year. And even Nasdaq, the global markets, you see Nasdaq and China, Nasdaq is up around 35+%, and China has given around 15.9% upside returns, and even gold has rallied around 27.57%. So if you keep this month of October aside, the rest of the year has been good for most of the asset classes, and a lot of wealth creation happened in last 1 year. So let's look at the key developments or key reasons for the fall in the month of October. The number one was the massive amount of FII outflows. We saw foreign institutionals taking out more than 1 lakh crore of money from the Indian equities. But at the same time, we saw domestic investors pumping a lot of money in the Indian equities. They did a buying of close to 1 lakh crore, which helped to mitigate the impact of this massive outflow, which has been the highest monthly outflow in the Indian markets. Secondly, historically, October tends to be a weak month for the stocks in the US markets during the US election year. And while November, December are expected to be more stronger months, with most gains occurring post-elections in the US. So global institutional investors, they basically generally try to de-risk their portfolio before the elections by booking profit. Since September, US Fed had done the rate cut, and which was around 0.5%. It was an aggressive rate cut, and instead of yields going down, we've seen the yields in US going up from 3.6% to close to 4.3%. And the key reasons for that is the strong data which we have seen in US. The labor and job data has been good, because of which the expectation of further rate cuts has been impacted. And we expect the foreign investors to come back with the inflows in Indian markets post the US elections, and probably a couple of more rate cuts by the US Fed. One of the meetings is expected this week, so we'll have to wait for the outcome. And similarly, the US election results should also be out in a couple of days. So both these events would shape the future. Now, if you look at the valuations of the Indian equities, we continue to believe that our markets are overvalued. The Nifty 500 P, if you look at it, is overvalued by around 25%, and the current P ratio is around 26.07. But if you look at the probably the equity buying strategy, if you want to look at that, then the current valuations look attractive. And if the portfolios or the investors have a lower equity allocations, which is below their strategic policy, then more equity can be added. We prefer large cap equity investments at this stage, because the valuations look better than the small and mid caps, where small, mid and micro caps are much more overvalued vis-a-vis the large caps. For investors having allocations as per the policy, the equity buying can be done if there is a meaningful correction in the valuations. So not of now, but if there are further corrections and we find the valuations are look better, and then the corrections have meaningful, then further buying can be done. For profit booking strategy, we suggest initiating profit taking in equity if the markets gets into the heated levels. The current valuation don't look like it's really heated at the point of time. Now for the US equity investments, we really believe that post union budget, the global funds have become attractive from a taxation perspective. So if you invest for more than 2 years, the long-term capital gains tax is around 12.5%. So from a diversification perspective, from a post-tax good return perspective. Now from the alternate asset allocation perspective, we stay bullish on gold and silver. From a long-term perspective, both gold and silver has been rallying for past one and couple of years. The central banks of Russia, India, China, they've been buying a lot of gold in the past months or years so to diversify from the US dollar. And that is also being caused because of the geopolitical tensions we have seen and the sanctions which came along post that. And this trend should continue. And but silver is also impacted by the increasing industrial demand in the new age industries like EVs, etc. So which should keep the silver prices going up for some time. So some allocations in gold and silver can be done. From our overall investor guidance, we anticipate continued growth, and investors should brace for the short-term volatility. While in the long term, we believe this rally should continue, but in short term, there could be a fair amount of volatility. So the investments in equity should be done from a 5 to 7 years perspective. With that time horizon, one can create good amount of wealth by investing continuously, right? And so this was the outlook for the month. I hope you found this interesting and really look forward to meet you soon.